Ford just did something that has the entire auto industry talking. Massive price cuts. Some models have dropped by over $10,000. Dealers are panicking. Customers are rushing in. And rivals? They're scrambling to respond. But this isn't just a sale. This could be the clearest sign yet that the U.S. auto market is entering a crisis. So what's really happening at Ford? And what does it mean for you? Stick around, because this might be the biggest shift in American car prices we've seen in over a decade. Ford's recent price cuts are not your typical end-of-quarter sales gimmick. This is a coordinated, sweeping set of reductions across multiple model lines, especially those in the electric vehicle, EV, and large truck segments. The Mustang Mach-E, for example, has seen price drops between $3,000 and $8,000 depending on trim. The F-150 Lightning, already a strategic priority for Ford, has had its price adjusted several times in just a few months, with some configurations now priced below what they were at launch. Even some ICE, internal combustion engine, models like the Ford Edge and Explorer are seeing major markdowns at dealerships as inventory piles up. This isn't just a discount, it's a pricing reset. Ford executives say they're responding to market realities, but behind that vague language lies a much deeper story about demand, inventory, competition, and economic pressure. So what's driving Ford to pull this trigger? There are a few interconnected forces at play here. First and foremost is oversupply. Ford, like many other automakers, ramped up production aggressively in 2022 and 2023 under the assumption that post-COVID demand would remain strong. But reality hit differently. Interest rates surged, inflation remained sticky, and consumer confidence eroded. Now, Ford finds itself sitting on months' worth of unsold vehicles, especially EVs and higher-priced trims that buyers just aren't snapping up anymore. Add to this the EV slowdown, where early adopters have already bought in and mainstream buyers are holding back due to charging anxiety, cost, and economic uncertainty. Ford is also facing pressure from Tesla's aggressive price cuts, which reshaped the EV market by forcing legacy automakers to compete on pricing. On top of all that, Ford's own production costs remain stubbornly high, particularly with union labor agreements, battery supply chain struggles, and dealership markups. Slashing prices is the only short-term lever they can pull to generate volume and stave off investor panic. The ripple effects of Ford's bombshell are already being felt across the auto market. First, it's putting enormous pressure on other legacy automakers, especially GM and Stellantis. If Ford can cut prices and still, hopefully, stay afloat, competitors may be forced to follow suit, triggering a potential price war. Second, it's reshaping buyer expectations. Consumers who were priced out of the market during the pandemic and chip shortage years are now seeing more affordable options come back. However, many are still wary, burned by sky-high markups, volatile interest rates, and fears of a collapsing used car market. Third, Ford's move could seriously undermine resale values, especially for recent buyers who paid more just months ago. This devalues the brand and creates long-term trust issues. Lastly, and perhaps most critically, these price cuts could accelerate dealership closures and destabilize profit margins, especially for Ford stores that rely on high-margin truck and SUV sales to stay afloat. If customers begin waiting for discounts instead of paying MSRP, it reshapes the entire dealership business model. This pricing shift also highlights the increasingly fragile state of the electric vehicle transition in the U.S. Ford has invested billions into electrification, factories, battery plants, partnerships, and yet it finds itself stuck in the middle. On one side, Tesla has the advantage of scale, direct-to-consumer sales, and cost leadership. On the other, Toyota is bypassing full EVs in favor of hybrids, which are cheaper, easier to produce, and more appealing to cost-conscious buyers. Ford's EVs, while praised for innovation, are expensive to make and often sold at a loss. Consumers, meanwhile, are cooling on EV enthusiasm due to poor charging infrastructure, high sticker prices, and general economic unease. And that brings us to the broader macro picture. Americans are struggling under record household debt, rising auto loan delinquencies, and stagnating wages. The new car market has simply outpriced too many people. Ford's price cuts may seem bold, but they're actually a symptom of deeper dysfunction in both the auto sector and the wider economy. If you're a buyer, this is both good news and a warning. The good news is obvious. Prices are finally coming down, and aggressively. Vehicles that were once out of reach may now be attainable again. If you've been waiting for a deal, this could be your moment. especially if you're flexible on trim or model year. But the warning is just as important. Be careful not to buy too early in what might become a race to the bottom. If Ford's price drops, start a chain reaction. Prices could fall even further in the next 6 to 12 months. There's also the risk that resale values collapse, particularly for EVs and trucks. Financing remains tricky too, with interest rates still high, so the monthly payment may not reflect the savings unless you negotiate hard or bring cash. Finally, there's the question of brand reliability and service support. With margins shrinking, some dealers may cut back on service quality, staff, or even shut down. So yes, it's a buyer's market, but it's also a market in transition, and that comes with risk. This price drop isn't the end of Ford's troubles. It's just the start of the next chapter. Going forward, Ford will need to make hard decisions, scaling back EV investments, renegotiating supply chains, streamlining its dealership model, and possibly reducing model complexity. Layoffs and plant closures could follow if sales don't rebound. Meanwhile, the auto industry as a whole is heading toward a dramatic reckoning. We're seeing a reset in car prices, a reconsideration of electrification timelines, and a serious confrontation with the limits of consumer demand. If Ford succeeds in navigating this pricing shakeup, it could come out leaner and more competitive. If not, it may face the kind of crisis that plagued GM during the Great Recession. For consumers, the next year will be full of opportunities, but also full of volatility. Buckle up. The road ahead is anything but smooth. Ford's current pricing crisis didn't come out of nowhere. It's the result of years of strategic miscalculations. For one, the company aggressively pushed into the EV space, hoping to catch up to Tesla, without fully understanding the cost dynamics or consumer hesitancy. Vehicles like the F-150 Lightning and Mustang Mach-E were launched with high expectations, but ran into production delays, quality issues, and, crucially, pricing that was too optimistic for middle-class buyers. At the same time, Ford kept its reliance on high-profit, high-margin trucks and SUVs, ignoring warning signs that the market was becoming oversaturated. The company also failed to adapt its dealership network quickly enough. Instead of embracing a leaner, direct-to-consumer model, Ford doubled down on an outdated dealer system with bloated inventories and inconsistent customer experiences. Combine all of that with inflation, supply chain chaos, and rising interest rates, and you've got the perfect storm that made these price cuts inevitable. Ford may have dropped the prices, but it's the dealers who are feeling the immediate pressure. Many Ford dealerships are expressing frustration, confusion, and even panic. Some are suddenly sitting on hundreds of thousands of dollars worth of inventory that's now worth less than they paid wholesale. Others are scrambling to adjust online listings and explain to angry customers why the vehicle they bought 2 weeks ago just dropped by $7,000. Behind the scenes, there's tension between Ford corporate and its dealer network. Dealers want clearer communication, price protection programs, and incentives to keep moving units. But Ford, facing Wall Street pressure, is focused on clearing inventory at any cost. As a result, many dealers are now prioritizing cash flow over profit, offering aggressive financing options, and even holding private flash sales just to stay in the game. It's a dangerous position, and if this continues, we may see smaller dealers start to fold or consolidate. Let's be honest, Tesla is still driving this pricing chaos, even if Ford doesn't want to admit it. Elon Musk's decision to start a price war in early 2023 by slashing prices across the Tesla lineup disrupted the entire market. Legacy automakers like Ford were forced to respond, but they don't have Tesla's advantages. Tesla doesn't deal with third-party dealers, has a leaner supply chain, and has vertically integrated much of its manufacturing process, especially around batteries and software. Ford, on the other hand, is still dependent on external suppliers, traditional dealerships, and union labor. Tesla's aggressive pricing has redefined consumer expectations, especially in the EV space. Now people expect premium EVs under $50,000. Ford simply can't hit that price point profitably, so they're stuck either selling at a loss or watching inventory rot. This asymmetric competition is eroding Ford's margins and credibility, and it's part of a much larger story about whether legacy automakers can really compete in the new EV-driven world. One of the most overlooked effects of this price bombshell is the damage to consumer trust. When prices drop this quickly, recent buyers feel betrayed. Imagine spending $60,000 on a Ford Lightning in January, only to see it advertised for $49,000 in May. That stings, and it's happening all over the country. These buyers are now underwater on their loans, their resale value is shot, and they're venting their frustration online. This kind of brand erosion is hard to recover from. Once consumers believe a company's pricing is unstable, or worse, predatory, they become hesitant to buy again. Ford risks developing a reputation for volatility, and that could hurt them even more in a market where buyers already feel cautious and overleveraged. Long-term brand equity takes decades to build, and only a few bad quarters to destroy. Ford's price cuts are also sending shockwaves through the used car market. As new vehicle prices drop, used car values follow, especially for late-model Ford vehicles. This is bad news for anyone who recently bought a used Ford, but good news for buyers. We're already seeing signs that used Ford trucks and EVs are depreciating faster than expected, and auction prices are trending downward. This also creates downward pressure across other brands as used vehicle pricing becomes more competitive overall. But there's a hidden risk: lenders. Banks and finance companies are watching used car collateral values drop rapidly, which increases the risk of auto loan defaults. If this spiral continues, it could lead to a second wave of credit tightening, making it harder for buyers to get financing, even as prices fall. It's a tricky balance, and the used car market is the canary in the coal mine. Price cuts almost always signal financial stress, and if sales don't rebound, cost-cutting is the next move. That's why many analysts believe Ford may be preparing for another round of layoffs or production slowdowns. Some of Ford's EV operations, like the Lightning production line, have already seen temporary shutdowns and scale-back targets. There are also growing rumors that certain U.S. plants could face idling or retooling, especially those producing slower-selling vehicles. In an environment where margins are evaporating, Ford will likely look to cut labor costs, renegotiate supply contracts, and delay new model launches. This creates even more uncertainty, not just for workers and suppliers, but for entire regions that depend on Ford factories to stay economically viable. A price cut today could become a pink slip tomorrow, and the industry knows it. This is the big question. Are we on the edge of a full-scale automotive price war? Ford may have fired the first major shot, but other automakers are under similar pressure. General Motors, Stellantis, Hyundai, Toyota, they're all watching closely. If Ford gains sales volume from these cuts, it's likely others will follow. That could be good for consumers in the short term, as prices drop further. But for the industry, it could be catastrophic. Most automakers are already operating on razor-thin margins due to rising costs, expensive EV R&D, and higher labor demands. A prolonged price war would crush profits, bankrupt weaker players, and force painful consolidations. It's happened before in the airline industry, in tech, and now we may be seeing it in autos. Ford's bombshell may be just the first explosion in a much bigger battle for survival. Ford has poured tens of billions into its electric vehicle transition, betting big on a future that's now looking shaky. From the Blue Oval City megacampus in Tennessee to battery joint ventures with SK On, the capital investments were enormous. But EV demand hasn't scaled at the pace Ford, or the market, expected. The result? Warehouses full of unsold EVs, underutilized production lines, and cash burn at a time when rates are high and debt is expensive. Wall Street is starting to question the ROI. Was this a premature bet? Is Ford overcommit to an EV vision the public doesn't want? At least not at the current price and infrastructure level. The price cuts are a signal not just of market adaptation, but of desperation to salvage sunk costs. The investment backlash is real, and Ford's balance sheet is feeling it. In the eyes of some investors, Ford's current strategy reflects a company caught between two eras, trying to innovate like Tesla, but still operating like GM in the 90s. Recent price cuts are being interpreted not as bold moves, but as signs of panic and profit collapse. Analysts are slashing price targets, warning of deteriorating margins, and speculating about dividend cuts. This is not the narrative investors want from a company mid-transformation. The stock is under pressure, and so is CEO Jim Farley. If Wall Street loses confidence that Ford can successfully manage the ICTV transition without bleeding out, we could see activist investors get involved, boardroom pressure escalate, and leadership changes become a real possibility. This could be Ford's Kodak moment, where they either pivot hard and fast or fade into legacy irrelevance. While Ford has tried to frame its price drops as strategic and limited, internal inventory levels suggest a different story. According to leaked dealership data and auto analyst reports, certain Ford models, especially F-150s and Mustang Mach-Es, are massively overstocked. Some regions have 90 to 120 days worth of supply, way above the 60-day norm. Why? Because Ford was still operating on COVID-era production assumptions, expecting supply shortages and panic buying. Instead, they now face a consumer market hesitant, over-leveraged, and interest rate sensitive. These cars aren't moving, and the longer they sit, the more expensive they become to hold. The price cuts are just the surface. Beneath it is an inventory glut so big that it could distort the car market for the rest of 2025. The United Auto Workers, UAW, isn't happy with how this is playing out. They've fought hard for wage increases, job protections, and better benefits, especially for workers in Ford's EV supply chain. But now, with prices falling and production targets being missed, Ford may look to claw back labor costs to protect margins. That sets up a direct confrontation with the UAW, which already feels betrayed by the slow pace of job creation in EV plants. And it raises deeper questions. Who's going to pay for this price war? If the answer is American workers, the UAW could respond with walkouts, strikes, or political pressure. This isn't just an economic story. It's a labor one too, and it could explode during the 2026 contract negotiations. Ford's pricing strategy in the U.S. could have a ripple effect globally. In Europe, where margins are tighter and competition from Chinese EVs like BYD is growing, any hint of price instability could destroy consumer confidence. In Latin America and Asia, Ford's already a niche player, and market confusion over U.S. pricing could hurt international positioning. If Ford starts exporting discounted models or overproducing and flooding overseas markets, it risks cannibalizing itself and destabilizing local dealer networks. Global automakers must maintain pricing consistency to protect their brand. If Ford loses that, especially in EV markets like Germany, the UK, or Australia, it could derail years of international progress. The price drops may start at home, but the aftershocks will be felt worldwide. Here's the hidden domino effect. When new car prices drop sharply, financing institutions get skittish. That's because loans issued even 6 months ago may now be underwater, putting pressure on both buyers and lenders. Ford Credit, the company's in-house financing arm, is facing a growing risk of negative equity, where buyers owe more than their car is worth. This can lead to lease defaults, loan rollovers, and an overall tightening of lending standards. If banks start pulling back, requiring higher down payments, raising APRs, or limiting approvals, it could choke off demand even further. Ford's price cuts may bring short-term buyers back, but the medium-term consequence could be a credit freeze for millions of consumers. Ford's price bombshell might be the final nail in the coffin for the traditional MSRP system. Consumers now know that what's on the sticker isn't what they should pay, and that discounts can arrive overnight. This undermines dealership transparency and creates a chaotic market where only the savviest negotiators win. More importantly, it breaks the value consistency that brands like Ford have depended on for decades. In a world where MSRP is meaningless and price volatility is normal, brand loyalty and resale confidence erode fast. We could be entering a new era where dynamic pricing, instant rebates, and real-time adjustments become the norm, similar to how airlines and hotels operate. But for the auto industry, which relies on stable pricing and long-term financing, that shift could be catastrophic. For over a century, the Ford name has been synonymous with American grit, engineering, and working-class reliability. The F-Series was the undisputed king of the road, and models like the Mustang symbolized freedom and raw power. But today, that iconic brand identity is in crisis. Why? Because Ford is trying to be everything at once: a heritage truck brand, a global EV innovator, a luxury tech player, and a mass-market affordable automaker. It's a branding mess. The once clear Ford image is now diluted. The average consumer sees a Ford dealership and doesn't know what they'll find: a $28,000 Maverick, a $60,000 Lightning that dropped in value by $15,000 overnight, a stripped-down Ranger, or a tech-laden Mustang Mach-E with Blue Cruise and mobile apps. There's no brand coherence. And in a market where trust and perception drive long-term loyalty, inconsistency is poison. Ford's leadership knows this. CEO Jim Farley has tried to divide the business into three branches: Ford Blue, gas vehicles; Model E, EVs; and Ford Pro, commercial vehicles. But instead of clarifying the brand, this move exposed the internal identity struggle. Are they competing with Tesla or Toyota? Are they selling mobility solutions or dependable trucks? Even dealers are confused, and the end customer feels that dissonance. Meanwhile, longtime Ford fans, those loyal F-150, Explorer, and Bronco buyers, feel alienated. They see rising prices, fewer incentives, and a confusing transition to EVs that often come with teething problems and software bugs. Younger buyers? They're looking at Tesla, Rivian, or Hyundai, not a brand try to stretch itself in 10 directions. The harsh truth? Ford has lost its center of gravity. And until it reclaims a clear, authentic identity, rooted either in dependable Americana or a bold new vision, it risks becoming a brand that stands for everything and means nothing. Ford's current brand strategy represents one of the most ambitious and risky reinventions in its 120-year history, an effort to pivot from an old-school, blue-collar icon of American manufacturing into a lean,